Hey everyone, and welcome to our June 2025 San Diego Real Estate and Economic Update. This is our summer update. So we're going to cover things that have happened over the last few months since the spring. With that, let's get started. Quick little introduction on myself. My name is Patrick Kappel. I have a little over 17 years of experience in the San Diego real estate market. I don't just work in real estate brokerage like many of you out there. I'm also a consumer of it. My wife and I own 8 investment properties here in San Diego that we've built up over the decade or two. I'm a board member of the Southern California Rental Housing Association, where I help guide and make decisions regarding the rental housing industry in Southern California. I also own and operate and manage the Kappel Realty Group, a top performing brokerage team here in San Diego that has sold over $500 million of San Diego real estate in just the last 5 years. And as you can see, last but not least, on the bottom left, I'm a retired Navy veteran. I served both enlisted and as an officer in the U.S. Navy, completing a career that included both active duty and the reserves, 24 years total, just retiring last year. You can see my education there in the center. I have a master's degree in real estate from the University of San Diego, an MBA with a focus in finance and real estate from UCLA, and an undergraduate degree, a Bachelor of Science from the U.S. Naval Academy. The awards, you can see there on the right, with a team that sells a little over 100 million per year, every year in San Diego. We definitely have racked up a fair amount of awards and recognition, and I take a lot of pride not just in the awards and recognition we've obtained, but more importantly, the way my team and I approach this business of real estate really comes down to that bullet point in the middle, education. Every time we work with our clients and anytime our clients works with any member of the Kappel Realty Group, you're not just going to be buying or selling real estate. You're also going to be educated throughout the process. We want to make sure that all of our clients are fully informed of the decisions they're making with real estate. That is why I do these webinars, maintain a YouTube channel, send out monthly newsletters to continuously educate our clients and the population of San Diego. Speaking of the team, here they are. We just got recognized within the last week by the thousands, Real Trends and the Wall Street Journal. Once per year, Real Trends and the Wall Street Journal combine to put out real estate team and individual rankings in San Diego. And we were ranked for, I think, third or fourth year in a row now as the number 1 team at the number 1 brokerage, that would be Compass, in the city of San Diego. And that's based on the number of homes we sold in 2024, 111 homes for just over 117 million. That's the team that you see in front of us. So when you work with me, when you work with Kappel Realty Group, this is the team of individuals you work with. All of them, 100% of them, highly educated. I think within a team of 15, we have about 8 master's degrees. Everyone has a bachelor's degree, and 100% of the agents on our team own and invest in San Diego real estate. With that, let's get into the presentation for tonight and take a look at what we will be covering throughout the rest of this evening. There's been a lot of changes, as we all know, over the last few months, especially with the major change in an administration. So I want to do a deep dive specifically in what's going on in San Diego. I also want to invite you to take a look at some of our other educational real estate videos on our YouTube channel. You can scan that code right there or just go to YouTube, type in Kappel Realty Group, and you'll find numerous videos such as how to invest in real estate, how to invest in 2 to 4 units, how to get free money in the form of a grant for your first home purchase, House Hacking 101, and many other real estate webinars to help educate you. So for tonight, I made a few bullet points of some major takeaways I want you to remember. Number 1, real estate prices will likely escalate this year. They already are, and they will likely continue that escalation and upward pressure on real estate values in San Diego. That said, not just real estate, likely the price of everything will go up this year. I think that goes without saying based on what you're probably seeing out there in the headlines. Additionally, interest rates, they're not going to take a nosedive. They might go down slightly or remain in the high 6s, low 7s. Most likely, right now we're in the high 6s. We started the year bouncing around 7. high sixes right now. By the end of the year, I wouldn't be surprised if we are still with a six handle in the front, perhaps towards the lower end of the six range, though. That said, bullet number four, if you're going to buy now. Why is that? Before prices get higher and you risk being priced out of the market. I can't tell you how many folks I've met that were waiting and waiting and waiting to buy, and eventually they discovered they no longer can buy because they priced themselves out because they thought real estate values would go down. But economics, the law of supply and demand, tell us prices will not go down, at least not a noticeable amount. As I mentioned a minute ago, it all comes down to supply and demand. In San Diego and really in the nation, we simply do not have enough supply, period. Demand is remaining strong in San Diego, and you'll see in some of the future slides, we still have population growth. We still have job growth in San Diego. Now, there are other markets, Texas and Florida, kind of the two poster childs, where we are seeing values go down, where we are seeing supply overshadow demand. But that is not the case in California, certainly not the case in San Diego, where we do not have enough supply relative to demand in our region. That is going to ensure San Diego values will remain strong, likely continue to go up, and if you buy real estate in San Diego, you're likely buying in one of the safest environments and locations to buy real estate due to that lack of supply and steady demand. Now, before we get into some raw numbers, let's take a look at some recent headlines. First of all, we all remember this. It seems so long ago, but it really wasn't. The devastating fires in Los Angeles County that wiped out well over 10,000 homes and businesses in the area. To put it in perspective, the number of homes that burned down during the January fires was more than the number of homes that sell in all of San Diego County in a calendar year. Think about that. The number of homes that sell in San Diego in a calendar year, more homes than that burned down in Los Angeles County at the start of this year. With that said, a supply crunch that already existed just got worse. In SoCal, we lost a lot of homes. And mark my word, many of those Los Angeles are moving down to Orange County, moving down to San Diego to find rental or homes to buy. Another headline, and this is a very important one. I like to say that San Diego still has more growth for appreciation. There's more room for San Diego home values to go up. Now, some of you might think I'm crazy because you're thinking to yourself, San Diego home values are already so high. How can they go higher? In fact, just last month, May, San Diego single family homes hit a new all-time record high. The median price of a single family home in San Diego in May was 1.1 million. The previous all-time high was back in April of 2024 when the record high was 1.09. Well, we just eclipsed that, as I mentioned, and the new median price is 1.1. But why do I think we can still go higher? Well, take a look at the stats in this article. Between Los Angeles, San Francisco, Anaheim, San Jose, and San Diego, five of our largest and most expensive cities, San Diego is the most affordable. How do we extrapolate that? Well, we look at the median income. For example, Los Angeles, you can see there the median income, $92,000. Median home price, just under $900,000 at $896. When you crunch the numbers, you can see that the share of median income needed to buy a median home is 77.6%. Now, let me be clear. Nobody's spending 77.6% of their income on their housing. However, most first-time home buyers are not buying homes at the median sales price. They're buying condos, they're buying townhomes for maybe $400,000, $500,000. Additionally, I hate to say this, but the median person is no longer buying homes. They're priced out. It's really the top 50%, for the most part, of income earners that are buying homes in Southern California. And if it's someone not in the top 50%, it's typically two people buying together, maybe a husband and wife, maybe a couple that's not married yet. We're seeing a lot of that, but a lot of folks are coming together to buy a home. Or the third option, mom and dad are helping out. We're seeing that a lot with Gen Z and younger millennials. But why do I say San Diego is the most affordable? Well, look at number five here, San Diego, 63.7%. That's the amount of median income that is needed to buy the median price home. Even though the median home in San Diego is slightly more than than LA, our incomes are higher here. Now, when you look at these other markets, especially San Francisco, folks there are spending 76.2% of the median income to afford and buy the median home. That tells me here in San Diego at 67.3, we still have about 10% growth we could have on the share of the median income for someone buying a house before things really start to peak. We have seen it in these other four cities that the pressure of lack of inventory relative to demand can truly create a situation where folks are economically spending over 70% of the median income on housing. We're not there yet. That tells me we still have room for appreciation. Is this good? Is it not good? Depends who you are. Are you a homeowner? Probably happy to hear this because prices can keep going up. Are you looking to buy a home? Perhaps you're also happy knowing that you could buy a home and it's not going to crash. There's still room for growth. Keep in mind too that median income in San Diego, 108,000, it's still continuing to go up. One other question you might be wondering, as I told you a moment ago, the new record price of a median home in San Diego is 1.1 million. Yet this article is telling us it's 905. What's with that? Well, that 905 is a combination of single family homes and condos and townhomes. It's single family homes that are selling around 1.1 million, condos and townhomes a little bit below the 900,000 mark. Another article that just recently came out, in fact, just the other day, San Diego has the highest inflation in the nation for a second month in a row. San Diego, when you look at all major cities in the United States, San Diego's inflation leads the pack. Another indicator that there is room for home prices to keep going up, and they truly are still going up, as I mentioned last month, hitting a new all-time high. Another thing worth mentioning is we have low sales right now, but high prices. You might hear in the news that San Diego home sales are at all-time lows. That doesn't mean home prices are going down. That doesn't mean there's a housing crisis or a crash on the horizon. All that means is that the inventory out there, there's a lot of inventory relative to a year or two ago, but not a lot of inventory compared to pre-COVID. We'll show you that in a few slides ahead. But a lot of folks are just simply priced out, or they're not finding the ways to buy a home right now, such as down payment assistance, which we'll talk about in a moment. But homes are still selling, just fewer than in previous years. There's a lot that the government is doing to try and solve this housing crisis. One is smaller lots, ADUs, bonus density. The problem is we got folks on both sides, some wanting to add this density, other folks not wanting to add the density, mainly citizens that don't want their neighborhoods to become more dense and more crowded. So we'll see how this plays out over time between adding the density versus NIMBYs, not in my backyard, people that don't want that density. I call it the push and pull between the developers and the local residents. As I mentioned, maybe many residents don't want a bunch of ADUs going up next door, so they're pushing back and getting city council a little bit on their side. In fact, just yesterday, city council met to put more restrictions on the ability to build ADUs, specifically numerous ADUs on one lot. Now, this article is interesting. There's always been daily trains going between Los Angeles and San Diego. However, in just this last month, Amtrak is now adding a 12th daily round trip train between LA and San Diego. Well, what does this have to do with real estate? People are changing jobs between LA, between San Diego. We got the folks that moved down here because of the fires in the Palisades area. A lot of those LA folks still have LA jobs, but moved to San Diego. Additionally, there's San Diegans that might have a mortgage on a house here, and perhaps their mortgage is 3%, 4%, and they just got an LA job, but they don't want to give up that low interest rate mortgage. Same goes true for folks that own a house in LA and maybe work in San Diego. Because of that, between these two metropolitans, we are starting to see more commuters living in one city, working in the other. Thus, the addition of a 12th daily round trip between San Diego and LA. Now, let's talk about recession for a moment, because you might hear that on the radio in the headlines talking with your friends. Recession risk outlook has gone up over the last few months for many reasons. There's tariffs that are being implemented. There's uncertainty out there. There are wars that are starting. However, keep in mind that in the last reading, just last quarter, amongst all economists surveyed, 45% say there is an elevated risk of recession in the next 12 months. What does that mean? 55% think there is not. So still the majority of economists polled do not think there's going to be a recession in the next year, but an increasing minority, up to 45%, now believe there will be. That said, how would a recession affect housing? The truth of the matter is, a recession does not mean home prices go down. Now, a recession could mean a lot of things go down. The stock market goes down. People start losing their jobs. Unemployment goes up. But usually, during recessions, home prices go up. You can see it in the chart in front of you. During the last 6 recessions, home prices actually went up during 4 of them. In fact, substantially over 6% during 3 of them. It's only 2 recessions in which home prices actually declined. The only one in which they declined really noticeably was 2008. And that was the Great Recession, where we saw home prices fall 19.7%. And that was because the recession in 2008 was caused by housing. We simply overbuilt housing back in the early 2000s, and it was way too easy to qualify for a loan. A lot has changed in the last 10 or 20 years. We have not built enough housing. In fact, we're way, way behind, and there's a deficit on the number of homes out there, number one. And number two, it has become much more challenging due to stricter guidelines and underwriting in order to qualify and get a mortgage. This has ensured a stable housing stock and a stable housing industry. So the bottom line is, if we do have a recession, what do I think would happen to home prices? They would likely go up. Why do home prices go up during a recession? Because home prices are heavily dependent on mortgage interest rates. Oftentimes, if mortgage interest rates go down, home prices go up. And typically during recessions, the government, the Federal Reserve, lowers interest rates to help keep the economy going. When the Federal Reserve lowers interest rates on the short-term borrowing costs, we then see interest rates typically go down on 10-year treasuries, and we often see mortgage rates go down. So if there is a recession on the horizon, rest assured the odds are home prices would still go up. Now, residential real estate values have been rising all across the United States, but as we see in the chart in front of you, in Southern California, we have seen some of the highest rates of home price appreciation over the last year. Specifically here in SoCal in general, home prices have gone up 7% plus in the last year. This is with elevated mortgage rates. Over the last year, as I mentioned earlier, interest rates have been around 7% plus or minus. Right now, we're kind of hanging out in the high 6s. So let me be very clear about this. If home values are increasing in the highest interest rate environment we've had in nearly 20 years, and if San Diego home prices hit a new all-time high in May of 2025 during the highest interest rates we've had in over 20 years, what do you think is going to happen when interest rates go down? And they are on that downward trend. I can tell you what will happen. As interest rates go down, as mortgage rates go down over the next year or two, we will certainly see home prices go up, perhaps even more and faster than what we have seen in the last year or two. How do we know this to be true? Well, we know it based on data. We know it based on historical facts. We know that when interest rates are above 7%, buyer demand is typically weak. When interest rates are between 6.5 to 7, buyer demand is a little stronger, but still limited. Once interest rates get below 6.5, buyer demand starts to pick up into the good section. Below 6% interest rates, we get strong buyer demand. So trust me when I say this, when interest rates get below 6, the market is going to go bananas. Once we get a 5 handle on the front of interest rates, you're going to see a ton of buyers come off the sideline wanting to buy real estate. Additionally, you're going to see a ton of homeowners that have been sitting on a 3, 4, 5% interest rate, not wanting to give that up, being willing to give it up once they see rates in the 5. So what am I telling my clients right now, especially my buyers? If you want to buy, if you want to buy anytime in the next 5 or 10 years, buy now. Well, there's not a lot of competition. Because as rates trend towards 5, and once they get in the 5s, if you're a buyer, you will face a lot of competition at that point, and you will wish you had instead bought earlier before rates drop too much. Now, if you're a first-time home buyer, you might not realize this fact, but if you buy a house today with a 6.5% mortgage, a 6.75, whatever your mortgage is today, if you buy that house today, you can refinance it. You can refinance it as many times as you want into a lower interest rates. So what we're seeing many clients do is they're buying homes today around a 6.5% interest rate. They're going to sit on that home, live in it, own it, and as rates go down over the next year or two, they'll refinance it into a 6. When rates go to 5.5, they'll refinance it to 5.5. When rates go to 5, they'll refinance it to 5. But they will be the smart buyers to have bought when prices were here and rates were 6.5, instead of when prices are here and rates are 5. There's a saying in real estate, marry the house, date the rate. And what we mean by that, buy the house you love at the price you can afford, and with the rate, date it. In other words, you're going to break up with that rate and refinance into a lower interest rate as rates go down. Let's talk a minute about inflation, because inflation is really why the Federal Reserve, the government, had to increase interest rates. That really affected borrowing costs across the board, from home mortgages to cars to credit cards to everything. Well, inflation is starting to near the 2% target goal. The government, the Federal Reserve, they want inflation at 2%. The most recent reading on inflation came out in May, just last month. That reading was 2.8%. Now, a lot of folks are wondering, if we're at 2.8, why is the Federal Reserve not lowering rates yet? Well, Jerome Powell, the chairman of the Federal Reserve, has made it very clear that he would rather be late than early as far as lowering rates. Because if the Federal Reserve lowers interest rates too soon, that could juice the economy back up and cause inflation to come roaring back in. Jerome Powell is a little bit concerned about the tariffs being set in. How's that going to affect inflation? A lot of our workforce, that might not be documented, but still part of our workforce, if they get deported, how is that going to affect inflation? When all of a sudden we have less workers, thus you have to pay those you still have more money to attract them. Additionally, as you see at the top of the slide, the last 1% is always the hardest. And the chairman of the Federal Reserve knows this. So he is waiting, taking a watch and see approach. I imagine by the end of this year, we'll have another 1, maybe 2 rate drops, but he's not going to be too bullish because he doesn't want to move too fast, too quick, and cause inflation to come back. So this is why I'm saying don't expect rates to drop a lot over the year, but do expect them to drop a little bit unless we see inflation starting to come back. What is the argument that we likely will see rates come down? over this year? Well, it's this. Unemployment claims are increasing. And the Federal Reserve is watching this. The Federal Reserve doesn't want us to have a recession, but they certainly do not want us to have inflation come roaring back. As unemployment claims continue to increase, that'll give incentive for the Federal Reserve later this year to start to lower interest rates. Keep in mind, though, as much as unemployment is rising, it is still near all-time historical lows. We came out of 2024 with some of the lowest unemployment in history, lowest unemployment since the 1960s. This last year of 2024 had one of the strongest economies. S&P hitting all-time highs, unemployment hitting all-time lows, inflation, which had been at 7%, being tamed and coming down into the twos. So really, we came out of 2024 with a really good economy. Was every American feeling it? No, but that's always the case. However, now with significant and drastic policy changes, we are seeing things shift around in the market, which means we could see inflation come back. We will see, as we already are, unemployment going back up. And we shall really stand by to see what happens over the next 12 months with the new administration and how that's going to affect the economy. We've seen the stock market go up and down, up and down. We saw, I think it was about 15 tariff policy changes over the first 90 days, and that made a lot of CEOs and business owners uncertain about what's going to happen. But at this point in the game, it's really a wait and see process. However, I can say if there's a recession or if there's not a recession, San Diego real estate values will likely continue to go up. This is why I believe San Diego is a good market to buy and to own real estate in. And again, I wouldn't say that if I didn't practice it myself. I practice what I preach, and I own numerous properties in San Diego. I own or have owned real estate in 4 different states as investments. And I can tell you my San Diego real estate has always outperformed all my other properties in other states such as Texas, Colorado, Missouri. San Diego is always number one. But don't just take my word for it. Take a look at what John Burns Research and Consulting put out in the last 2 years. What you're looking at right now is May of 2024, and the next slide is going to be May of 2025. So we can see the year-over-year change. Every year, John Burns, which is perhaps the foremost and most respected real estate consulting firm in the United States, they look at every major market and state across the United States. And last year, in May of 2024, they rated 14% of markets slow, 57% is normal, and 29% is strong or very strong. The only markets last year that were ranked as strong, or excuse me, very strong, are those that you see circled in the bottom left: San Diego, Orange County, and Riverside. Of all the areas in the United States of America, those were the 3 strongest market. The best to own in, the best to buy in, the most poised for appreciation, the most poised for growth, and the most poised to ensure you don't lose money in your real estate should there be any economic changes. Well, let's take a look at what happened over the last 12 months. Let's take a look at May now of 2025. Things have gotten worse for most other markets. 33% of markets this year are ranked as slow, 54% is normal, and only 12% is strong or very strong. And amongst those ranked as very strong, instead of 3, now only 2 are ranked as very strong: Orange County and San Diego. What does this mean for you? What this means is if you are investing in real estate in Texas, in Florida, any of these areas that have red dots, do not expect your values to appreciate much. In fact, if you live in an area like Texas or Florida, you very well are losing money. and your real estate values are depreciating. Now, this is interesting to note because the populations of Texas and Florida have grown a lot. A lot of people have moved to those two states in the last few years. Jobs have grown in Florida, in Texas in the last few years. So if people are moving to these two states and jobs have grown, why are real estate values going down? Why is the market softening in Texas, Florida, and some of these other southern states? The answer is simple. They have more supply than they do demand. It's so easy to add and build housing in Texas, to add and build housing in Florida. So much supply has been added that it has softened the market, and the amount of supply has started to overshadow the demand. That is not true in Orange County or San Diego. You that might live here in San Diego know that it's very hard to build in San Diego. In fact, we're almost out of real land to build on. There's not much left. To the north, we have Camp Pendleton. To the east, we have the Cleveland National Forest. To the south, we have Mexico. And to the west, we have the Pacific Ocean. We are really locked in, for all intents and purposes, on what we can build on. Additionally, government regulations make it very challenging to build. The cost make it very prohibitive to build. Yet San Diego's population is still growing, and still growing with a lot of white-collared folks moving here to work in tech and in biotech. So what does that mean to you if you're a buyer? If there is only one market in the United States of America that you could buy in to ensure that your asset, the real estate you buy, holds its value, and to ensure you make and build some wealth by that asset appreciating, that one market would be San Diego. If you live in San Diego, you are fortunate because you are one of the few Americans that A, just lives in San Diego and has beautiful weather, but B, has the ability to buy $1 million property, price of a home here, with very little money down because you can buy it owner occupied. Next, let's look at job growth. I mentioned job growth a little bit, and I mentioned how it's really growing out in places like Texas and Florida, yet real estate values are still taking a hit because they have so much real estate there. But where is job growth happening in California? Amongst the major cities I showed you, from Sacramento to San Francisco to LA, the only city amongst these majors that is still having positive job growth is San Diego. You can see it boxed in there in the red, 0.6% job growth year over year down here in the San Diego area. And that job growth isn't just low income jobs. There's a lot of high income tech and biotech job growth still happening in San Diego. Now, this slide kind of ties together what I was talking about. There's a lot of folks moving into Texas, moving into Florida, moving to the East and the Midwest. Not as much moving into California, right? But as I often say, it doesn't matter just how many people move, but it matters who moves, and it matters how much real estate supply you have. What you see in the chart on the left is what we call months of available supply. This means how much real estate is there available for sale. And we call it months because 2.7 months, for example, in Southern California, if no new inventory came to market today, how many months would it take for all the existing inventory to sell off? 2.7 months. So we'd say in Southern California, we have 2.7 months of inventory. Now, inventory is growing all across the nation. You can see all the red dots, the pink dots. That means the number of listings is growing. But in Southern California, it's still not growing enough to cause prices to come down. We call a balanced market 6 months. When you have 6 months of inventory, that's pretty balanced. If you have less than 6 months of inventory, home prices will likely go up. If you have less than 3 months of inventory, home prices are almost certainly going to go up. If you have more than 6 months of inventory, prices will likely go down. So as you can see, in Florida, we have a lot of inventory of housing. That's why we're seeing prices go down out there. As you can see in Texas, we have a lot of inventory of housing. That's why we're seeing prices soften out there. In Southern California, 2.7 months of inventory is not much. This is why we're still seeing prices go up. The lack of affordability I mentioned here ensures rental demand. However, San Diego is still the most affordable coastal market. Take a look at these five major markets that I've talked about before: San Francisco, San Jose, Orange County, Los Angeles, and San Diego. And as we saw in that previous headline, there is no coastal California market that is more affordable than San Diego. Now, I've been to all these cities, and I imagine some of you have too, and I might be biased because I live in San Diego, but I don't think I'm biased when I say this. San Diego has some of the best weather. San Diego has the most job growth, as we saw in this previous slide right here. So if San Diego has the most job growth amongst these five cities on top, and if San Diego's job growth also is amongst the white-collared, high-paying folks moving into San Diego, because you're going to see in a future slide, most people moving from San Diego to San Diego are coming from these top cities: San Francisco, San Jose, Orange County, Los Angeles. They are seeing San Diego as a bargain, as a steal, because it's cheap relative to where they're coming from. And San Diego is yet still the most affordable. This is why I say with a very confident and straight face, San Diego real estate values still have room for growth. It has a lot more room for maturing into a large city like we've seen in LA, like we've seen in San Francisco. I mentioned the folks moving into San Diego are coming from these higher cost areas, and take a look here. You can see where folks are moving into San Diego from. It's Los Angeles, it's San Francisco, it's the East Bay, it's Orange County, it's Boston, it's Pensacola, it's Santa Barbara. I was just there last weekend. It's New York, it's San Jose. It's all these cities here in the green. The net moves in. So as I mentioned, it doesn't matter just how many move in and out, but who. And folks moving here from San Francisco, from Orange County, from Santa Barbara, they're selling their homes for like 3, 4, 5 million, and they're coming down here to San Diego and buying homes all cash. Because when you sell a home in a place like Santa Barbara for millions of dollars, you can come back down here to San Diego and certainly buy something all cash. And as I mentioned, our population is still growing. It's projected to slow its growth in the coming years, especially with the new policies coming from the administration regarding immigration, because the majority of San Diego's growth has come from our birth rate and immigrants moving in. So we'll have to track closely over the next year, how do administration policies on immigration affect our growth? But as of now, San Diego's population is certainly still growing. Affordability. I bring this one up because a lot of folks say to me, well, Patrick, aren't you supposed to spend just 1/3 of your income on housing? That is true if you live in a place like North Dakota, where I was born and raised, or the Midwest, but it's not a blanket statement. It really depends on where you live. Now, of course, if you live in North Dakota, you spend a lot more money on energy, gas, oil, and electricity to keep your house warm throughout the frigid winters. Don't have that so much in San Diego, but your cost of housing shouldn't just be a blanket statement of 1/3 of your income. It depends on what your income is, it depends on where you live. In higher cost areas, you usually have a higher level of amenities. You usually have more things to do. You usually have more hospitals, better health, higher quality of life, better weather. And as my wife tells me, in life, you get what you pay for. And I've learned that firsthand. I've been to all 50 states, and I have lived in 7 different locations. As you can imagine, I served in the Navy 24 years, and I can tell you this, it's my opinion, but I'm sure many would agree. San Diego is one of, if not the best place in the United States of America to live when it comes to weather, when it comes to hospitals, when it comes to an abundance of activity that you can do from the mountains to the ocean to the deserts and everything in between. So back to you get what you pay for. You can move to the Midwest and pay 1/3 of your income on housing. How happy will you be? Or you can live in San Diego, where the historical norm was 41%, but that is going up to a new norm of 50%. Housing should get a bit more affordable. over the coming years as interest rates go down and incomes continue to go up. But housing will never be super cheap in San Diego because it's San Diego. You're really getting the best environment to grow and to raise a family in if one of your goals in life is to be able to spend 12 months a year outdoors. Now you can see, are people really spending 50, 60, 70% of their income on housing? No, 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 not at all. Again, these are looking at medians. Most first-time home buyers don't buy the median price home. They buy a cheaper home, something for 4, 5, 600,000, like a condo. In San Diego, I often say your first home is probably not going to be a single-family detached home. It's probably going to be a condo or a townhome. I know it was for me. My first 2 homes in San Diego were condos. It wasn't until I bought my 3rd home that it was truly a detached single-family home. How are folks buying homes if they can't afford it on their own? As I mentioned before, either they're wealthy, making good money, healthy 6 figures and buying on their own, or they're buying with 2 incomes, either married or not married, or here's this 3rd option. We're seeing a lot of Gen Z and even some millennials buying with the help of parents. In fact, as you can see in front of you, 42% of Gen Zers buying homes are getting help from mom and dad. 40% of renters even are getting help from mom and dad. Let's talk about this bright spot here, though, in the economy. California this year became the 4th largest economy in the world. And actually, that happened towards the end of last year. So who did we overtake? India. The economies in the world are ranked in this order. United States economy is the largest, followed by China, followed by Germany, followed by California, and then India. Think about that for a moment. The size of California's economy is larger than every other country in the world except for 3. California, if it were a country, would be one of the wealthiest, most powerful economic countries in the world. A huge portion of America's economy is attributed to California. With that said, you can't go wrong buying real estate in strong economic regions, especially a region like San Diego. Especially San Diego, by the way, is the fastest growing economy in California. California is the fastest growing economy in the world. So what does that tell you? San Diego is one of the fastest growing economies in the world. Certainly a good place to put your chips if you're a betting person. Certainly a good place to buy and hold real estate in the city that has one of the fastest growing economies in the world. This is why I am so personally bullish on owning San Diego real estate. And I didn't just stop with 1 property or 2 or 3 or 4. As you saw from my degrees, I study economics, I study real estate, I study finance. When I first moved to San Diego 20 years ago, I was so poor, I couldn't afford a bed. I could barely afford my rent, barely. And after my rent, I could not afford furniture. So for my first year here, I literally slept on the floor. Thank God it was carpet. And over the years, I did what one of my mentors told me: buy real estate, never sell it. And I just kept buying. I just kept buying. Was it easy? No, it was very challenging. But nothing worthwhile in life is easy. So my goal in life is to help other people do what I did, build wealth. More importantly, though, build financial security by owning real estate instead of renting it. Let's look at a few more slides, and then I want to show you a bit of math. First of all, can more inventory soften prices? As we have seen, inventory has gone up. For sale homes have gone up in San Diego, in California, all throughout the nation. Is that going to soften prices? It might cause them to not go up as quickly, but as you saw in previous slides, inventory level, months of supply, is not that high in California or in San Diego. Other states, other parts of the nation, yes, absolutely. I meet so many people that say they want to leave San Diego because it's so expensive, so unaffordable. So they move somewhere like Texas or they move somewhere like Florida, not realizing that sure, they might go buy a house for 300,000 in Texas or Florida, but in 10 years, that $300,000 home might be worth 300,000 or maybe a little bit more, maybe 400,000. Whereas they could have bought a home in San Diego for 3, 4, 500,000, that would be a condo. And in 10, 15 years, it could be worth $1 million. Why do I say that so confidently? Because San Diego real estate values appreciate, on average, about 5 to 6% a year, meaning the value of San Diego real estate doubles about every 15 years. Will home prices continue to rise? Absolutely. Fannie Mae did a survey, and December for 2025, it's expected home prices to rise 3.4. In every subsequent year through 2009, home prices are expected to rise between 3 to 4%. Now, this is national average. Nationally, real estate values usually go up with a rate of inflation around 2 to 3%. But in San Diego, which is different than the rest of the nation, home prices typically go up about twice the amount of the rest of the nation. The historical rate of appreciation for American real estate over the last 50 years is about 2 to 3%. Historical rate of appreciation for San Diego real estate over the last 50 years is about 5 to 6%, twice the amount. So I think you can anticipate San Diego real estate values going up year over year, the numbers in front of you, times 2. Why is that again? Lack of housing. We just don't have the inventory or the ability to add the inventory like they do in so many other states. And speaking of inventory, there is no crash on the horizon, certainly not in SoCal, probably not throughout the United States. There's no crash, certainly not like what we saw during the Great Recession, 2007, 8, and 9. Leading up to the Great Recession of 2007, 8, and 9, we built too much housing. You can see 2020, 2002, 2003, 2004, 2005, 2006. We built too much housing relative to the demand. And after the Great Recession of 07 and 08, we went into a period of 15 years of underbuilding. Now that would be bad in and of itself, but what makes it even worse is that 15 years of underbuilding is now intersected with millennials and Gen Z hitting their 20s, their 30s, and millennials now even hitting their 40s. Why is this important? Because most first-time home buyers buy their first home in their 20s and 30s. And we have the biggest generation in American history, millennials, followed by Gen Z, hitting their 20s and 30s at the intersection of the lowest amount of building in American history. Let that sink in for a moment. That is why we have a housing crisis of not enough supply. And mark my word when I say this, this housing crisis will not be corrected in my lifetime. We are just far too underbuilt relative to our population. Now, before we get into math, let me cover some of the biggest mistakes that I see buyers make. Number one, trying to time the market. You just can't time the market. Here's how you can time the market. Buy now and wait. We have a saying in real estate, the best time to buy is yesterday. The second best time to buy is today. I've got another saying, and this is one I made up. The idiot who overpaid for a property in 1992 is way wealthier than the idiot who didn't buy anything in 1992. And I say 1992, you can fill in the blank with any year that you want. What am I really saying? Overpaying for a property and holding it for 5, 10, 20 years is far better than never buying a property at all. Now, I'm not telling you to go out there and overpay for a property. Do not do that. But what I am saying is instead of timing the market, instead of trying to find that unicorn of a deal, it is far better to buy something and then just wait, sit on it, than to buy nothing. As my mentor told me in my 20s, he said, Patrick, buy real estate, never sell it. And that is what I have done with my own life. Number two, overextending budgets. I see some buyers that say, if I can't buy my dream home, I don't want to buy a home. Well, here's a news flash. The first home you buy is probably not going to be your dream home. Not for too many people, unless you're a trust fund baby and you got a lot of money. But for most people, your first home is called a starter home because it's a starter home. And it gives you that leg up. It gets you up the first rung of the ladder, helps you to build equity. You build equity in your first home, which might be a condo. It might be a townhome. It might not have that backyard. But by buying your first home, that might not be your dream home, but owning it for 5, 10 years, you build up the equity that you can now use to buy your second home, which might be your dream home. For me, it wasn't. I didn't buy my dream home until my third. When I bought my third home, I thought, oh my God, this is it. I love this home. This is my dream home. I'm going to live here forever. Well, guess what happened? I lived in my dream home for about 10 years, 11 years, and I built up a lot of equity. That home's value doubled over 10 years. I bought it for 700,000 at the time. It's worth over 2 million now. So what did that home allow me to do? Buy my dream home. A home I didn't even think I ever could afford. The sooner you start though, the better. And the more likely you can buy your dream home one time. Because the one thing that builds the equity that allows you to buy that dream home someday, is time. So buy early. If you're in your 20s, buy now. If you're in your 30s, buy now. If you're in your 40s, you're a little bit behind the power curve. A lot of other folks have already bought in their 20s and 30s, but don't worry, it's not too late. Go out there and buy so that by the time you get to your 50s, you can buy your dream home. If you're in your 50s or 60s already, I would still say buy because renting is going to be a lot more expensive over time, as we'll see. Number three, missing out on assistance programs. Guys, there are like over a dozen down payment assistance programs in San Diego and the state of California combined. We have gotten our clients over $1 million in down payment assistance that is typically tax-free, interest-free. California or San Diego will give you your down payment. So if you're a first-time home buyer, definitely reach out to me and my team and I can help you get that down payment money for free. Number four, not leaning on the expertise of the pros. Guys, let me tell you this. Buying real estate is complex. I hate to say this, but it's true. HGTV, Selling Sunset, Flip This House, or whatever they are, I don't even watch them anymore. Those shows do us a disservice because they make it look so easy. When you buy a house or a condo in San Diego, there are thousands of pages of paperwork, countless inspections, hundreds of thousands of dollars, if not millions of dollars, being transferred and moved around. And you might think you're not moving millions of dollars or hundreds of thousands. No, the bank is. The bank is helping you buy that house with your loan. Buying real estate is the biggest financial transaction in your life. And just like you wouldn't hire someone for the most important medical decision of your life, open heart surgery, um, don't hire someone for the biggest financial decision of your life simply because it's a friend of a friend, or it's your cousin, or your brother, or your mom, or whatever, fill in the blank. Someone called you. Hire someone for their level of expertise. And more importantly, the comfort that they give you throughout the process of buying or selling your home. But hire someone for their level of expertise. I can tell you this, the average agent in San Diego sells 2 to 4 homes a year. If you do something 2 to 4 times a year, you're probably not that good at it. You want to ensure you work with someone who is buying and selling homes every month, every quarter, so that they're at the top of the game. Work with a pro. Can't stress that enough. A couple more things. Real estate voted best long-term investment. I wouldn't disagree with that. That came from a recent Gallup poll in 2025. Not only is it a great long-term investment, but trust me, as someone who understands the tax code pretty well, I was a teaching assistant in grad school for a real estate and business taxation class at UCLA. And I can say this for certain, there are few, if any, investments that have more tax advantages than real estate. Real estate is just littered throughout the tax code with tax advantages. Now let's do a little bit of a dive into some San Diego statistics. What is going on in San Diego County with real estate over the last month and really over the last year? And if you really want to go back, take a look at the bottom chart over the last 10 years plus. So how much inventory is there right now in San Diego County? Well, you can see blue and red bars. What are those? Blue signifies single family detached homes. Red signifies attached. What does that mean? Townhomes, condos, any type of home that would be attached. Now, as you can see, inventory is much higher now than it was a year ago. In May, just this last month, single family homes, we had 3,556 for sale. A year ago, we had far less, 2,992 in June of 2024. So inventory has gone up significantly in the last year. However, I like to pull back and show you the full 10, 12-year timeline going back to 2013, as you can see in the bottom, to show you that as much as inventory has gone up in the last year, it's still very low compared to historical norms. In fact, you look at historical norms, the blue line, single family detached homes, usually in San Diego County before COVID, we used to have 8 to 10,000 homes for sale any given month. And now we're just sitting around 3,500. Why is that? One of it is we haven't built enough. The second reason is what we call the lock-in effect. So many homeowners are locked into low interest rates that they got during the pandemic, and maybe they got a 3 or 4% interest rate. They don't want to sell that home and give up that 3 or 4% interest rate. Even if they want to go buy a new home, they might prefer just staying in their current home or turning their current home into a rental, something I and many of my clients have done. Next slide is days on market until sale. So what does this mean? From the moment a for sale sign goes in the yard to the moment an offer is accepted. Now, as you can see, top left under May, the blue line shows us 2025 single family homes are selling in about 30 days and attached homes in about 37. Why are attached homes taking a little bit longer? Well, because they're more common. In San Diego, we're not building that many more detached homes, but we're building a lot of attached homes, condos and townhomes. So when I look at this data, what does it tell me? It tells me that single family homes sell a lot faster and the value of single family homes will probably appreciate faster and more than attached homes. I get this question a lot. Patrick, what is going to appreciate more? Detached home or attached homes? People ask me this all the time. And the answer is quite easy. Detached homes. Detached homes will appreciate more for the simple reason that we're building less of them. And we're building more attached homes, more condos, more townhomes. And if I ever need to answer a question myself, I always go back to the basics, supply and demand. And if we're adding more supply of attached homes and less supply of detached, and lack of supply causes prices to go up, you're going to see prices go up faster on detached homes. It doesn't mean prices aren't going to go up on condos and townhomes. They will go up, perhaps just not as fast. It also doesn't mean you shouldn't buy a condo or a townhome. You should, if that is what you can afford. The best first home for you is not the home you want. It's not the home you love. It's the home you can afford. You buy the first home, one you can afford, so that someday you can buy the home that you love, your dream home. That's real estate. Percent of original list price received. What does this mean? Well, kind of self-explanatory, but of the list price, the offer price that is accepted is what percent of the list price. And let me give you an example. So May of 2025, 98.7. So most attached homes are selling at 98.7% of list price. And if you go back to 2013, you see that historically over the last decade plus, all San Diego homes and condos sell about 95 to 105% of list price, We were hitting like 105, 106, 107% of list price back in 2021, 2022, when the market was going bananas. And this is why I say, hey, if interest rates go down, fives, certainly in the fours, you're going to see that happen again. You're going to see the market go bananas. You're going to see homes selling well above list price if rates get back into the fours and the fives. That's why I say buy now while homes are still relatively cheap relative to what they're going to be. And this is where people say, well, Patrick, aren't homes already kind of expensive? And I say, well, yeah, they're expensive compared to a year ago, compared to 5 years ago, compared to 10 years ago. But everything is, number one. And number two, if you want to be successful with your financial decision making, you can't have just the ability to see today because everybody can see today. You can't have the ability to see yesterday because everybody can see yesterday. You have to have the ability to see the future. Most people don't have the ability to see the future. Why? Because they haven't taken a bunch of economics and finance classes. But if you take enough economics and finance classes, or just listen to this 1 hour webinar every now and then, you'll start to develop the ability to see the future. Why is that important? Because the price of real estate today is always going to seem expensive, no matter what day it is. 1981, 1991, 2001, 2011, 2025. It's always going to seem expensive. 2035 in the future. The price of real estate today is always going to seem expensive. You got to compare it to the price of real estate in the future. Now, most people compare it to the price of real estate in the past. Anyone can do that. Fifth grader can do it. Don't do what fifth graders can do. Do what someone like you, intelligent, can do. Look into the future. Where will home prices be in the future? Hopefully, you've kind of extrapolated from all the data, charts, and graphs I've shared with you that real estate prices in San Diego will very likely be higher in the future. Now, does that mean they're going to be higher in a month, in 2 months? It's almost impossible to predict the next month or two. But in economics, time gives certainty. The more time, the more certainty. And I can say with a very high level of certainty, prices will very likely be higher 3, 4, 5 years out, especially as rates go down. Next, months of supply. I already mentioned this, but we have less supply on single family homes than we do with multifamily, attached homes, condos, and townhomes. This is why we only have 2.9 months of supply of single family home, 3.7 months of attached. Now, supply has gone up a lot. Months of inventory has gone up a lot in the last year or two, but still not at historical norms. Getting close, however. You can see historical norms would put us closer to 4 to 5 months of supply, and we are getting close to that. Now, here's a big slide. Open your eyes for this one. Median sales price. This is where I say we hit a new all-time record high. Now, I'm going to differentiate single-family home versus attached. So in the blue, you see detached single-family homes hit that new record high of 1.1 million. And as you see, in 2024, the previous high was April 2024 at 1.09. We just rocked it and we just hit a new high, 1.1. Is it going to keep going up? Maybe a little, maybe a little. I don't think it's going to go up a lot, but it'll keep going up a little. When interest rates go down, then yes, home prices will go up a lot. And that's what I'm saying, buy before rates go down. Because if rates go down, prices go up, you'll be paying tens of thousands, if not hundreds of thousands more for the same house. So you might as well buy before prices go up further. And as we see, prices have also gone up for attached homes, condos and townhomes. They're sitting at 690,000, not at, but very close to the previous record high of 700,000. For those who might hear from their brother, their brother-in-law, their uncle, their aunt, their coworker, their friend, that there's a housing crash on the horizon. When those people talk, plug your ears, stop listening to them, because they probably don't know what they're talking about. There is no housing crash on the horizon. As you can see in the chart in front of you, to have a crash, you have to have too much supply relative to demand. And we just don't have that much supply. Not only do we not have that much supply, we certainly don't have distressed sales. As you can see from the Great Recession of 08, 9, 10, 11, 12, there were a lot of distressed sales. Today, very, very small fraction, almost unaccountable. There are so few distressed sales. Someone asked me last week, I was a keynote speaker in the last week at 2 different real estate events. And last week, I was speaking with a woman who came up to me and she said, Patrick, don't you think there's going to be a real estate correction in the near future? And I said to her, when you were in elementary school and you did a math question, if the question was 2 plus 2 and you wrote in 4, you're obviously right, and the teacher corrected your paper and they marked it wrong, would that bother you? And she said, yes. And I said, of course it would, because you can't correct something that isn't wrong. 2 plus 2 is 4. That's accurate. We know it's not wrong. You can't correct it because it's not wrong. 1.1 million for a home in San Diego is not incorrect. It is correct. It is correct based on supply, based on demand. To have a housing correction, something must be incorrect. You can't correct something that's not incorrect. There is nothing incorrect with the value of San Diego real estate right now. If anything, the value of San Diego real estate should be a little bit higher, as you saw in previous charts, where the value of San Francisco, LA, Orange County, Sacramento, East County, all those values of real estate relative to income in those cities, real estate values are higher. Not so in San Diego. So San Diego still has room for growth. If there is something incorrect in San Diego, it's that home prices are not high as they ought to be based on supply, demand, and income relative to other coastal California cities. So is there a crash in San Diego? Absolutely not. There's nothing incorrect, certainly not incorrectly high, about today's prices in San Diego. I'm getting towards the end, but one last note on the magic of math. Now, I love magic. Who doesn't love magic? In fact, I remember when I was like a 3rd grader, my mom and dad got me a magic set. And I loved playing with that magic set. I do private shows for my family, my mom and dad. And then I got into middle school and then junior high and high school, and I became a math nerd. I loved math. I was always in AP math. And I was always, when I was in 9th grade, I was taking 10th grade math. When I was in 11th grade, I was taking 12th grade math. And when I was in 12th grade, I was taking college math because I love math. And thus Bachelor of Science in the Navy. Why? Because math is truly magical. It is because it shows you the truth. I always say, and I heard this from someone, it's not my line, people can lie with words, but not with numbers. Math shows the truth. So let's use some math to see some truth, to see a little math magic. Now, here's a question. This is the trick. What if you could rent a place for $3,000 a month? Or you could buy and own the exact same place for $3,990 a month. Which one would you do? Now, most people would say $3,000 a month is a lot cheaper than $39.90 a month. So they would say it's cheaper to rent than it is to own. All right? I would disagree. I would say $39.90 is a lot cheaper than $3,000 when we peel back the layers of math. What do I mean by this? Let's dive into a spreadsheet because math magic, I hate to say it, happens on spreadsheets, which I know are probably boring and confusing looking. I get it. I never used a spreadsheet really in my life until I went to business school and got that MBA, but then I learned to love spreadsheets because they really speak a language that is honest. The calculations are amazing. What you're looking at in front of you is a spreadsheet I built when I was getting a master's degree in real estate. And while I was getting a master's degree in real estate, I was also working in brokerage. And I would often come upon clients that would say, Patrick, why should I own instead of renting? Because renting is cheaper than owning. And I knew why they were saying that. They were saying that because the news, the podcast, their brother, their mother, their friend, their coworker, was telling them that renting was cheaper than owning. And they were telling them that because the example you see in front of you. I'm going to zoom in on this example, rent versus own. 801 West Hawthorne Street. You see the address in the top left. I know this property very well because I own this property. It's worth about $500,000. That's what I could sell it for. Now, let's say you could have two options. You could buy it from me for $500,000, or you could rent it from me for $3,000. I know it rents for that because I rent it out. I got tenants in there. I've had tenants in there for a decade. About $3,000 a month is what they pay. Now, you could buy it instead of renting it. And if you buy it for $500,000, closing costs 1%, down payment $25,000. You see it here on the left. It's about 5% down. And here's the lucky thing for you. You don't even need that $25,000 because we can get you that money for free from the city or state as a grant. Down payment assistance programs, done a lot of them. Let's say your loan is 6.5%. And oh, by the way, that might be your loan interest rate today, but that's going to go down over time. Because like I said earlier, you can refinance it 1,000,000 times if you want to lower interest rates. Now let's put in a few assumptions that are very accurate. I know this because I work in real estate. Annual rate of appreciation, 6%. San Diego over the last 35 years has appreciated on average 6% per year. Is it going to keep appreciating at that amount? No, it's probably going to appreciate more. Why do I say that so confidently? Because we're out of land to build. We've shifted from a blue to a white-collared city. And we just are not adding housing the way we used to in the last 35 years. Because of that, we'll probably see more appreciation. But let's be conservative. And let's assume the appreciation in the next 30 years is equivalent to the appreciation average we've had in the last 35. Buyer's rent, you can rent it for $3,000. And how much does rent go up? Now, your rent in the state of California, even with rent control, can go up anywhere between 5 to 10% a year. Your landlord can increase it. Even if there's no inflation, landlord can still increase it 5, at the most 10. So let's assume you have a nice landlord and they increase it only 5%. Now you might be thinking you have a super, super nice landlord and they're never increasing your rent and they never do increase your rent. And that's cool. And that might be the way it is for a couple of years, a few years, but trust me, it's not going to be like that for 30 years. Because the nice landlord you have now, they're not going to be renting to you in 30 years probably because they're not going to own it anymore. You're going to have moved. Something's going to have changed. You're not going to have anything locked in for the long term like you could if you buy. Amortizing, you see on top, yes, that means you pay off the loan over time. Taxes. Well, taxes, they exist. And if you own real estate in San Diego, in the county, taxes are probably going to be about 1.25% of purchase price. You also got to pay annual homeowner insurance and HOA, which we'll say is $400 a month. Now let's look at the math. Payment year one. If you own it, you add in your principal payment, your interest payment, your taxes, your insurance, your HOA. You're paying $3,990 a month. If you rent it from me, I told you you could, you're paying only $3,000. Now, that's $909 difference. Most people would stop thinking here. Most podcasters, probably most YouTubers, most media newscasters, your mom, your dad, your brother, your sister, your aunt, your uncle, your friend, your coworker. I call that the peanut gallery. People that are speaking to you about your decisions, even though they don't know anything about real estate or very little. Most people, perhaps even you, stop thinking here. And you would say $3,000 is cheaper than $39.90. So renting is cheaper than owning. So I'm going to rent. Now I'm asking you, for your sake, for your good, for your financial health, do not stop thinking here. There's some more behind the black magic curtain here that we're about to show you. And I will say this. I hope you live a long time. But if you only have a year or two left to live, then yes, maybe rent. But I hope you're going to live another 10, 20, 30 years, if not more. And if you're going to live 30 years or more, heck, even 10 or 20, it makes sense to own, because let's look into the future. Remember, I told you, you will not run away from the pack or stand out or become financially successful by looking at the past and the present. Everyone can do that. You got to be able to look at the future. So with a spreadsheet, we're going to look in the future. Let's look forward 30 years. Over the next 30 years, if you own this property and you are paying your taxes, insurance, and your mortgage, and your taxes and insurance go up a little bit every year. Over 30 years, you'll pay 1.597 million, almost 1.6 million. However, if you rent that same property, and if your $3,000 a month rent goes up only 5% a year, over 30 years, you will pay 2.391, almost $2.4 million. If you rent this property over the course of 30 years, you'll pay 794, almost $800,000 more. So which one looks more expensive now? Renting over the long term is far more expensive than owning. But it goes further. After 30 years, what happens? Maybe you're in your 20s, you're in your 30s, you're in your 40s right now. So you're probably going to live longer than 30 years. What happens on year 31? What happens at year 31 when you want to retire? Can you retire? Let's see. Well, if you own, your monthly payment at year 31 goes down to $2,042 to be exact. How is that? Well, your $3,990 mortgage goes away because you paid off your mortgage. So all you have to pay now is your taxes, your insurance, and your HOA. And even with those going up 2 or 3% a year like inflation, your monthly payment in 31 years is only $2,000. Whereas if you are that renter, you're now paying over $12,000 a month. That's right, not a year, a month. It's math. If you take $3,000 a month in rent today, and if $3,000 per month in rent today goes up only 5% per year, 5% a year increases, after 30 years, you're now paying over $12,000 a month in rent. This is why, now this is a phrase I made up, but it's true. The only people that can afford to rent are the wealthy, because renting is by far the most expensive option. Now, you might think that you're not wealthy and you can't afford to buy. Trust me, take it from a guy who couldn't afford a bed when I moved to San Diego 20 years ago. And now I own 8 homes. How did that happen? Because I didn't believe what 90% of people told me. I believed what the top 1, 2, 3% told me, that anyone can make it. We live in America, the land of the free. Anyone can make it. If you think you can't own, call me. Guarantee you, we will find a way. I'm not a military veteran because I don't find ways. We'll find a way. There's not a single human being I've ever met that we couldn't help them find a way to own a home. And keep that in mind, that renting is for the wealthy because it is expensive. And if you think you can't afford, if you keep on renting, you never will be able to afford because your costs keep going up. But that's not it. There's one more to uncover. Let's take a look. What is this? Net worth increase. So you might be thinking, why would I pay $1.597 million to buy a $500,000 property? Because over 30 years, that $500,000 property appreciating at 6% a year for 30 years will come to a value of over $3 million. If you buy a $500,000 property today and you own it for 30 years, you will be a multi-millionaire. Guarantee it. Come find me, I'll pay you the difference if you're not. This is the magic of math. You want to be a multi-millionaire? You don't need to play the lottery. You don't need to be a rock star. You don't need to inherit it. All you have to do is this one thing. Buy a $500,000 condo in San Diego and then sit back and wait. You'll be a millionaire, and soon after that, you'll be a multimillionaire. Now imagine this. You buy a $500,000 condo today and you're in your 20s, 30s, maybe 40s, and you own it for 30 years and you never sell it. 30 years from now, you have a net worth of $3 million because you own that condo still. And maybe you moved out of it. Maybe you moved out of San Diego, but you kept that condo because you're smart. You turned it into a rental. And at year 31, as the owner of that rental condo now, you're paying $2,000 a month in taxes, insurance, and HOA. But you're making over $12,000 a month in rent. The difference there is 10,000. If you're making 12, you're paying 2, you're cash flowing 10,000 a month, $120,000 a year. That is your retirement plan. That is a better pension than any job is going to give you. That is a better pension than a 401k is going to give you. Gives you a net worth of 3 million plus cash flow 10,000 a month. Get out of here. It's crazy, but it's real. It's the magic of math. It's the magic of real estate. Do this with 1 condo. Do it with 2 condos. Do it with 3 condos. Do it with 8 properties. That's what I did throughout my 20s and 30s. 44 now. Do it. I can tell you it'll change your life. But I've learned this one thing. I know a lot of rich people and I know a lot of poor people. I know everything in between. Maybe because I grew up and have lived on both sides of the track. The difference I often see between those who are financially successful and those who are not. Those who are financially secure, those who are not. It's often not just education. It's often not intelligence. There's a lot of stupid rich people, and there's a lot of intelligent poor people. The difference is usually action. Those who take action versus those who do not. Those who take action usually end up ahead. I'm telling you, if you think about owning, own. Way better than renting. And again, if you're thinking about waiting for interest rates to drop, that could be a fatal mistake, a fatal flaw. Why do I say that so confidently? Because look at this, folks. If interest rates go down 2.5%, you could see home prices go up 33%. What do I mean by that? Well, today, someone who wants a $4,000 a month mortgage with 7% interest rate can buy a home for around $750,000. That doesn't include taxes, insurance, and HOA, just principal and interest. Someone who wants that same mortgage payment, when rates go to 4.5%, can now afford $1 million home. So as rates go down, you can afford more home, right? You might think as rates go down, you can get a bigger, cooler home, more square footage, more bedrooms, better location. But that's simply not the case. Why? Because sellers, they're not generous people. They want as much money as they can get for their house. And we have a lack of inventory. So as interest rates go down, you, the buyer, all of a sudden, instead of buying the $750,000 house, you think you can buy the $8, the $9, the $1 million house. Not the case. You're buying the same house that you used to be able to buy for $750,000. It's just now you're paying $1 million for it because interest rates went down. But we don't have much supply, so sellers just increase their price. That's the way the world works. That's the way real estate works. A few last slides to close it out. Home ownership, no doubt, remains the #1 feature of the American dream. Above retiring, career, and college degree, most Americans want to own a home, especially Gen Z and millennials. When polled, 95.5% Gen Z and millennials want to own a home. And as I said, that's the biggest generation coming up, the first-time home buying age right now. Gen Z, though, has a few concerns. Top 5 obstacles they anticipate. #1, not having enough savings for a down payment. Don't worry about that. Biggest concern, check, taken care of, got it. Free down payment money available for you. My team, I believe, likely gets more down payment money for our clients than any other team in San Diego, if not the nation, because we really focus on helping first-time home buyers getting that down payment money. #2, 20.8% don't know where to begin. Well, that's easy. You usually don't begin by going on like Zillow or some random website. You begin by calling, emailing, texting, messaging, reaching out in any way you can to someone to advise you. If that's me, great. If that's someone else, great. Just make it someone you trust, someone that's going to educate you. If you reach out to me to work with my team and I, we typically set aside an hour or two. We sit down with you in person or on Zoom, whichever you prefer. We talk about you for an hour or two. And we talk about what your goals are, what kind of house you want to buy, when you want to buy, any obstacles we need to get over. And then we educate you. further on the real estate market, on the various neighborhood, the properties, the loan types that you can use, and the buying process. That's how you begin. I mentioned the down payment assistance. These are two of the bigger programs that give out down payments assistance. It's San Diego Housing Commission and California Housing Finance Authority, the agency. An example of a down payment assistance program is, let's say we help you buy a $600,000 home, could be a detached or a condo, and we get you 3.5% your down payment covered by CalHFA or San Diego. They will give you $21,000 for free, tax-free, by the way, to buy your first home. Done it a million times. In fact, my team, the Kappel Realty Group, over the last few years, we have helped our clients get over $1 million cold hard cash to go towards down payment of their first home purchase. And you might think you're not buying your first home, you're buying your second. Well, guess what? The state of California, if you're buying your first home or your second home, but you haven't owner-occupied a home in 36 months, that's a first home. Let me say that again more clear. If you haven't lived in a home that you own in the last 36 months, then you're a first-time home buyer and you can access some of that money. I'll close it out with this. In order to cross the finish line, and everyone wants to cross the finish line. I used to run track when I was in high school. Everybody wants to cross the finish line. But you know what people are afraid to do? Cross the starting line. Keep this in mind, not just in real estate, but all things in life. In order to cross the finish line, and in this case, that could be keys in your hand to your first home, your first investment property, your second home. But if you want to cross that finish line, you must first cross the starting line. So what does a starting line look like? As I mentioned, it looks like a meeting with my team and I. If you're interested in buying real estate in San Diego, be it an investment property or an owner-occupied property, my team sells both. We sell, again, about 110, 120 million per year, some years 140. About half of that is investment property, duplexes, fourplexes, quads. The other half, owner-occupied property, single-family homes, condos, townhomes. But what does the starting line look like in both of those situations? Sitting down with me and one of my team members, again on Zoom or in person, whichever you prefer, and we help guide you throughout the process. It costs nothing to meet with us. I love meeting with people. It's what we do. That's our job, is to meet with people and guide you, coach you, teach you, help you buy and sell real estate in San Diego. Who you work with matters. Make sure you work with a trusted team. And again, the team you see in front of you is one of the top teams, not just in San Diego, but in the United States of America. Very professional, very educated, and very dedicated to you and everyone that we help. I'll close it out with this last slide to again share with you the link to check out our other videos on our YouTube channel. If you're watching this now, you're probably already on it. But we have a lot of other interesting and educational videos that I think you'll find highly valuable on that YouTube channel. Thank you for watching. I really appreciate it. If you want to watch more videos and know when new videos hit, feel free to push the subscribe button and you'll be able to see every time we have a new video drop, a new market update, or any other topic. Also follow us on Instagram and Facebook. Just type my name into Google, Patrick Kappel. You'll find a lot of information on me. Research me. Always research people that you work with to make sure they're legit, make sure they're good. With that, I hope you're doing well wherever you are, and I hope that one day my team and I can serve you and help you in real estate. Thank you.